It's the end of the month again, and you all know what that means. That's right, it's time for paper games to be played again to manage the metals prices. I bet most of you are surprised to hear me say this. After all, I've said on countless occasions that I've come to believe that what's causing the metals prices to be lower than what we'd like to see is future market short selling by mining companies who are seeking to generate a fixed price profit for future production. Many take this to mean that I don't believe in government collusion to suppress metals prices. And to a certain extent, I do believe that the central banks jawbone the price of gold down when it suits their interests. But it's the large quantity of paper futures contracts acting as a surrogate for metals that does all the heavy lifting. But I've also said many times that I do believe in short-term manipulation. The sudden smackdown on Friday was something that I was expecting to see, and if I'm reading the options data correctly, we're likely to see some further manipulation on Monday. But this manipulation was the handiwork of different players. It was the result of the people who stand to lose a large chunk of money in the options market if the prices of the metals don't stay within a certain range. You'll notice on this chart at the top that the May gold and silver options contracts expire on April the 27th. That's this coming Tuesday. So these few days are when all of the options owners will be expecting to exercise their options. And as a consequence, these are the few days when the writers of those options will have to make payments for any options that are in the money. For those of you who are unfamiliar with what an option is, let me briefly explain. An options contract gives the owner of the option the right, but not the obligation, to buy or sell an underlying item at a pre-negotiated price called the strike price. An option that gives the owner the right to buy at a certain price is called a call, and an option that gives the owner the right to sell at a certain price is called a put. For example, someone who was bullish on the price of gold and wanted to make a big bet could have bought May 2021 call options with a strike price at, let's say, $1,800. Call options on gold are for 100-ounce lots. So if by the April 27th expiry date the price of gold climbed to, let's say, $50 above strike, then each call option would be worth $5,000. The reason for this is that the owner now has the right to buy 100 ounces of gold at a price that is 50% below spot. Usually the options are settled in cash rather than metal. After all, they're just bets on price movement. Of course, the money that goes into the pocket of the option owner has to come from somewhere. Where does it come from? Well, it comes from the option writer. There are large institutions out there that make lots of money writing calls and put options. How do they make their money? Well, if the options they write expire out of the money, they get to keep the premium that they were paid by the buyer of the option. These institutions are quite well funded and powerful. They have the ability to conduct short-term manipulations to make sure that the options that they write will expire largely out of the money. And they have a very large incentive to do so. Let me show you why. I created this chart using the open interest and strike prices of all of the May gold call and put contracts that have yet to be exercised. What it shows as a function of the gold price is the total value of all of the in-the-money calls and puts at various gold prices. At very low gold prices, you can see that there is very little value to the unexercised call options, but quite a bit of value in the unexercised put options. This should make good intuitive sense to everyone. At low gold prices, the owners of the puts with various strike prices will have the right to sell gold at higher prices than market, but the owners of the calls won't benefit unless their strike price is quite low. Now, on the other side of the graph, at high gold prices, we can see that the existing puts are worth very little money, but the call options become worth quite a lot. If we analyze this graph, we can see the motivation behind price manipulation close to option expiry. If gold reaches $1,800 per ounce before Tuesday, it will mean that the writers of all of the options will be out of $115.5 million. And most of this will be forfeited by the writers of the call options. This is powerful incentive to try to run some trading stops to get the price lower. Now, where do you suppose that the option writers will want to see the price of gold settle? The answer is $1,750 per ounce. This is the point of maximum pain for the combined owners of all the puts and calls. This is the point at which the greatest number of them will expire worthless. It is the point where the writers of the options will forfeit the least amount of money. And at $1,750 per ounce, the options are worth only $62.8 million combined. There are tens of millions of dollars at stake for the option writers if the price stays at its current level. I looked at the max pain point for the GLD ETF and also a few miners, and all of them suggest additional price weakness will benefit the option writers. So expect more games to be played on Monday. What does the picture look like for silver? Let's take a look. As we can see, the option writers really did not want to see the silver price advance to $27 per ounce. If it had, the value of all of the call options would have grown by quite a bit. Each of these options, by the way, represents 5,000 ounces of silver. At $27, the total value of all the put and call option contracts is worth $154.7 million. And that's a pretty big pot of money, hence the smackdown. The max pain point for the option owners is $25.50 per ounce. At this point, all of the options are worth only $131.6 million. One thing we can notice that's different about this chart for silver than the chart for gold is that the minimum is much less sharp. It takes a much larger percentage change in the silver price to reduce the amount of money the option writers are on the hook for. A 6% change in the silver price is worth about $30 million to the option writers, whereas a 3% change in the gold price is worth $62 million. The incentive to push gold lower at this point is greater than it is for silver. But there is still incentive there, so I'd expect some further price weakness in the white metal on Monday. We'll have to wait and see what actually happens. I don't have a crystal ball. All I can notice is motivation. Once we get past options expiry on Tuesday, the paper game will reset, and it'll be a wash, rinse, and repeat. As always, folks, keep a long-term focus and buy real physical metal. These paper games will continue to be played, and the little guy will get fleeced trying to play them.